They're coming to get you, Barbara.
By the end of the decade, banks are dropping like flies. Regulators figure it's going to cost roughly $25 billion to pay off insured depositors of failed banks. But the FDIC doesn't have anywhere near that much.
Altogether, we lost 3,000 banks and S&Ls during the decade of the 1980s to failure. 3,000. And many of them were some of the largest banks in the country. Hundreds of farm banks collapsed and energy banks.
The FDIC doesn't want these banks to close, because then they'd be on the hook to pay off all the depositors. So they take a head-in-the-sand approach and decide that the best plan is to keep these banks open, paying out more than they're taking in, turning them into zombie banks. Zombie banks are banks with a negative net worth. They are dead, yet still able to operate due to government backing or bailouts. The FDIC tries to attract bigger deposits to these failing banks by raising the limit on deposit insurance from $40,000 to $100,000. Then they changed the rules to allow S&Ls to become less conservative in their lending practices. They're permitted, even encouraged, to make dicier loans.
Small banks now need to start throwing Hail Mary passes in order to stay in business. So they start making riskier and riskier bets.
They were allowed to get into esoteric investments in ways that they should not have been able to, and that their charters didn't normally allow them to, but the government then allowed them to.
You're gambling for resurrection, if you will, where you think you can make a lot of money, but if you don't, somebody else bears the loss.
The once steadiest segment of banking is suddenly shaky.
We knew that we were going to be dealing with bank failures and S&L failures beyond what anybody had ever contemplated. We have got to keep the public from panicking, because we can take care of things if the depositors don't run on the banks. You're going to have to nationalize all the banks if that happens. Our big mission was to keep people calm, to assure them that we wouldn't let it get out of control.
Deregulation looks like an across-the-board good thing, but unfortunately for zombie banks and failing S&Ls, the good news arrives too late and has an adverse effect.
What starts to happen is the savings loans in particular expand beyond the real estate industry. They start investing in a wide variety of other types of things. It's not necessarily they're being fraudulent or anything like this. They're being allowed to do a lot more.
Well, let's do construction lending. Let's use broker deposit. And that turned out to be a toxic combination. Hot money, funding, high-risk lending activities. Very lucrative, or so it appeared.
No one would have given S&L's deposits that wasn't insured by the FDIC. See, it's only because they had more money to lend that they could make bad loans. Anybody else would never have made those bad loans to those companies because they didn't have the deposits to do so, and they would have lost money doing so.
When the S&L industry basically became a lottery or roulette wheel, the good bankers didn't want to play the game. They left, and the bad guys all showed up, and suddenly they became CEOs of S&Ls. They bought S&Ls because it was legalized gambling with other people's money. And if you lost, the government stepped in and bailed everybody out.
Essentially, con men came in and said, hey, we can buy a savings and loan and use it as our piggy bank to fund all our little projects.
You read colorful stories about bankers who served champagne to their clients by pouring it out of cowboy boots.
The scumbags, the guys who would do anything, because those kinds of environment foster that. They encourage that, they reward that.
Human nature, greed, the scumbags, the operators come in, buy savings and loans, and you're off and running. The mania begins, and it builds and builds and builds.
So now, with the entire savings and loan industry threatening to collapse, the government desperately needs to get out from under. Centuries-old restrictions against branching and interstate banking are suddenly out the window as the FDIC holds a fire sale, peddling small banks and failed S&Ls to larger banks.
And now we get to undo the 160-year reign of unit banking, because it's now the path of least resistance to relax unit banking laws.
The Glass-Steagall Act prohibited commercial banks from branching across state lines, whereas the savings and loans were not subject to Glass-Steagall. So that became one of the ways of breaking down the interstate barriers.
How about if we tell some people in North Carolina or Ohio, you know, we're willing to let you come in across state lines to absorb some of these banks that are failing, but you're going to have to do something for us.
They weren't able to start a new branch by law, but they could buy an existing failed bank, you know, cover each some of the losses, and sometimes the government would help them out with those losses, but it allowed them to enter different markets.
Deregulation allows banks to pay higher interest so that they can attract funds that will allow them to compete in the marketplace. It also opens the door for them to make a broader range of investments. Suddenly, new businesses and startups are able to get credit to fund expansion and innovation. Creativity comes back into banking. We get financial innovation like money market funds, stock market mutual funds, and high-yield bonds that make it possible for the ordinary investor to invest in a wide, diversified range of social and technological advancements. Computers, cell phones, satellites, and cablevision, Microsoft, Apple, AT&T, movie studios, Las Vegas resorts, healthcare, utilities, mining, and a host of other innovations and developments. Between 1984 and 2007, after half a century of stagnation, America gets 3 of the 5 longest, most prosperous expansions in her entire history, all courtesy of deregulation. In the years following World War II, the populist face of America moves from the farms and countryside to the inner cities, becoming a powerful segment that politicians are eager to exploit. In 1965, as part of Lyndon Johnson's Great Society program, the Department of Housing and Urban Development is created. HUD's stated mission is to ensure quality, affordable homes for all. Then in 1977, Congress ups the ante with the Community Reinvestment Act, which is intended to encourage depository institutions to, quote, help meet the credit needs of the communities in which they operate, including low and moderate income neighborhoods consistent with safe and sound operation.
The Democratic Party passes the CRA under Jimmy Carter in 1977. In the context of the 1970s, in which banks do not compete very hard against one another, they don't look very hard for solid borrowers in low-income neighborhoods.
The idea behind the Community Reinvestment Act was that everybody should own their home, and that what's happening now is that banks are only going into the wealthy areas. We want you to go into the poorer areas and offer the same loan programs and more incentives.
The CRA mandates that each bank's record in contributing to its community be periodically reviewed by federal regulators, and that members of the public may submit comments on a bank's performance. These comments will be taken into account in considering a bank's application for deposit facilities.
The politicians who like to use public policy to ingratiate themselves with the voters have just decided that they have to make a certain amount of housing available to people who otherwise wouldn't be able to qualify for it.
Why would you do that? Why are you forcing banks to spend money in communities where they can't make sound loans? Because if they could make sound loans, they would.
Why? I'll tell you why. Because the politicians know they can get away with it. Who's gonna stand up for a bunch of fat cat bankers? And you don't even hear the bankers complain. By this time, they think getting screwed is part of the job.
For most banks, when they make lending decisions based on a mandate from Washington, they write those loans off. They just assume that they're a dead loss. It's the price of doing business. You know, banks are regulated entities. They have a charter that's granted by the government. They have federal deposit insurance. So as a quid pro quo for that, the politicians extract their pound of flesh.
And now that pound is about to start growing.
There was a belief that these pernicious bankers didn't want to bank people who looked not so much like themselves. You know, you had these white shoe Greenwich bankers, they weren't going into Detroit. And so the idea, it seemed like, well, let's just make them go to Detroit and everything will be great. But they didn't understand what the problems could be with flooding those areas with loans, and they didn't understand the ramifications of unleashing this force without any regulatory leash to pull it back in.
If government intervenes too much to the point where it facilitates lending that can't be supported by income, then it actually starts to encourage the bottom of society to get into a debt trap.
They just didn't recognize that without putting any safeguards on there, you're opening it up to much more sophisticated people taking advantage of unsophisticated people.